Strategy publishes a public Bitcoin credit model for its 53B stack strategy. The software company turned Bitcoin holding vehicle led by Michael Saylor published a public Bitcoin credit model on August 12, 2026, according to a CoinDesk report. The framework maps credit spreads, under-collateralization risk, and Bitcoin floor prices across a position the company values at roughly $53 billion. The move is unusual. Most corporate holders disclose how much Bitcoin they own and leave the leverage math to analysts. Strategy is instead handing out the model itself, the same variables that determine when its debt load starts to press against the value of its coins. The numbers. Strategy chose to show the published model centers on three quantities. Credit spreads measure the extra yield investors demand to hold Strategy's debt over a risk-free benchmark, a live read on how the market prices its default risk. Undercollateralization risk describes the point at which the Bitcoin backing the debt would no longer cover it. Floor prices name the Bitcoin levels where those pressures bite. Bitcoin traded at $63,788 as of August 12, 2026, down 0.4% on the day, with the Fear and Greed Index sitting at 37 or fear per CoinMarketCap data in the same snapshot. That backdrop matters for a leveraged holder. A model that looks comfortable at $63,000 can look very different if the price grinds lower, and Strategy is now inviting the market to run that scenario in the open. A leverage bet. Disclosed on purpose, Strategy funds much of its Bitcoin buying through convertible notes and preferred stock rather than pure cash from operations. That structure amplifies gains when Bitcoin rises and amplifies strain when it falls. Publishing a credit model is a bet that transparency lowers the risk premium investors attach to that structure. If lenders can see the floor prices and stress points for themselves, the reasoning goes, they price the debt more calmly than they would guessing in the dark. The counterargument is just as clear. A public floor price is also a target. Traders now have an official reference for where Strategy's balance sheet gets uncomfortable, and short sellers tend to probe exactly those levels. Saylor is trading a measure of strategic ambiguity for credibility, and the market will decide whether that trade pays. For a company whose equity trades largely as a proxy for its Bitcoin holdings, the credit model also gives shareholders a cleaner way to judge the gap between the stock and the coins behind it. That gap has been the core debate around Strategy for years. The read-through for everyday holders. Strategy's disclosure is a corporate finance event, not a card or spending story, but the underlying lesson travels down to individual holders. Leverage against Bitcoin has a floor price, and the people who survive drawdowns are the ones who know theirs before the market finds it. That logic applies to the growing set of products that let users borrow against crypto instead of selling it. Services that offer crypto-backed borrowing run the same collateral math strategy just published, only at retail scale, and a sharp price move can trigger liquidations well before a borrower expects. Anyone using a card or credit line funded by volatile collateral is exposed to the same under-collateralization risk, which is why stablecoin-based spending removes a variable that leverage Bitcoin positions cannot. The distinction between owning an asset outright and borrowing against it is the same one that separates self-custody spending from custodial credit. A floor price only exists when there is debt in the structure. Hold spot Bitcoin with no loan against it, and there is no margin call to fear. Only price. Add leverage, and the floor strategy just drew for itself becomes a line every borrower has to draw for their own position.